What's going on, guys? I hope all is well. My name is Rico, and if you haven't already, I would love for you to subscribe to the channel and hit that like button. I wanted to talk about the correlation between the stock market, money policy, meaning the Federal Reserve, and cycles in the economy. As you guys can remember, back in the pandemic, the market crashed. The market crashed as far as the stock market, and also the economy went down due to the pandemic. And when that happened, we had the Federal Reserve step in, because the Federal Reserve is the money supply to the economy. They're the blood supply to the economy. Their job, as elected by Congress, is to be able to keep the economy stable, keep the economy going. And when the pandemic happened, things crashed. Main Street, meaning the businesses, struggle, and also Wall Street, the market crash. So when that happens, when that happened, the Federal Reserve started to implement quantitative easing. So meaning with quantitative easing, they made the money supply or the money policy easy. They start to buy more bonds and eject more money into society, and that caused the Main Street to do better as far as the businesses, and also that caused Wall Street, caused the market to rise back up. And since then, since the 2020 time frame, everything has been on a bull run. Everything has been in a has been going up as far as the market. And this year, things have changed, because with the easy money policy that we've had, with all the money that has been injected into the economy, that has changed, because right now the Federal Reserve is doing quantitative tightening, meaning they are taking money out the system. All the money that was put inside the system was stimulus and all the bond buying. That money is coming out the system as of now. And right now you're seeing the bear economy with quantitative tightening. And right now with the quantitative tightening, the Federal Reserve, they are taking money out the economy, and also they are raising interest rates, because right now we are in a high inflation environment. And since this year, the stock market, all three indexes are down, with the Dow Jones, the S&P 500, and the NASDAQ. All three of those indexes are down right now. And right now you're seeing the bear economy, with all the liquidity, all the money that has been taken out. And as you can see, it's a difference between investing in the economy that we had back in 2020 versus the economy that we have now. Back in 2020, when we had an easy money policy, when we had the quick recession, and then we had the expansion due to the policy of the Federal Reserve, everything was going up as far as the stock market. All the stocks were going up. You can basically close your eyes and choose a stock, because when money is plentiful like that, and when interest rates are very low like that, it's easier, or it's the market goes up, and also businesses can borrow money at lower rates, essentially. And that's why you saw those companies, those growth companies, those stocks, those companies that are not making any money right now, those stocks were up big time during that time frame. Those growth stocks like Roku, the ARK Fund, Carvana, just all the growth companies, these companies that are not making any money right now, but they benefit from lower interest rates, because they're able to borrow money at a lower interest rate, and to be able to invest to make the company better. But right now, you see those type of stocks are down in this type of environment that we're in now, because right now, interest rates are rising back up right now, because the Federal Reserve has to stop demand. They have to be able to break the demand right now. So as you can see, the stocks that are not making money, or the companies that are not making money right now, those stocks are the stocks that are struggling right now. And the companies that are doing well right now are the companies that are making money. Those companies that have a profit. Those companies that have earnings. Those companies that are well established. So there's a big difference in the way that you invest in an environment that has higher interest rates versus an environment that has lower interest rates. Also, there's a difference the way you invest versus, a recession versus an expansion or peak period. So you have to know kind of like what period, or what's the dynamic of the environment that you're in right now. And don't think about, that it's a horrible time to invest in the stock market, because there's always a bull market somewhere. There's always a place to put your money somewhere. So it's always somewhere to put your money. Even though right now all three indexes are down right now, there's always a stock. There's always a company to place your money in. Your job as an investor is to be able to go out and find those stocks. As they say, this is a stock pickers market. Meaning, back a couple years ago, back in 2020, you could choose any stock, and those stocks were going up essentially because of the ease of money policy. Now, with the money that's being taken out of the economy, you have to be a stock picker, meaning you have to really do research and do your fundamental analysis, technical analysis, and see what's going on with these companies. See if they're making an earnings. See what products they have. See what's the overall trajectory of that company. And this is how you're going to succeed in the market that we are in right now. So I just want to let you guys know, there's definitely a difference between investing in certain periods versus easy money policy versus a policy that's tightening, as we are in now with higher interest rates, and that's a different dynamic. So definitely know that it's a bull market somewhere, and just do your research, do your due diligence, and learn about these dynamics of the quantitative easing versus the quantitative tightening from the Federal Reserve, and that's going to give you an idea of just the overall dynamic of what's going on right now in our world. So I appreciate you guys listening to this message, and if you could, definitely hit that subscribe button, hit that like button, and I appreciate you guys for checking out this video. And I just thank you guys, and place a comment in the chat. Let me know what you're thinking about. Let me know what you think about what's going on with the overall market. So I appreciate you guys. Peace.